Hey everyone, and welcome back to The Explainer. I am absolutely thrilled to have you here today because, look, we are going to demystify what is arguably the most critical, yet surprisingly misunderstood safety net you could ever put in place for your family. We spend so much time optimizing our investments, tracking the stock market, looking for the next big thing, but today, we're going back to the absolute foundation of financial planning. We're talking about term insurance. By the end of this explainer, you're going to know exactly how it works, why it matters so much, and how to use it to completely bulletproof your family's financial future. Okay, let's dive into this. I want you to picture a scenario for a second. Think of a 35-year-old salaried professional. He's doing pretty well, right? Earning about 15 lakhs per year. He's built this wonderful life. He's got aging parents he looks after, a loving spouse, two young, super energetic kids. And, like pretty much all of us, he's also carrying a home loan. Now, imagine one day something deeply unexpected happens. And boom, he is suddenly no longer there to support his family. That income that literally fueled their entire existence, it just stops overnight. So what happens next? How on earth is the family going to pay that massive home loan without his core income? How are those two young kids going to fund their college education? How does his spouse manage the daily living expenses, the grocery bills, the utilities, the health care for the aging parents? The emotional loss is already unimaginable, but without a plan in place, a massive financial catastrophe follows right on its heels. And this, right here, is exactly where our topic today becomes a non-negotiable necessity. To figure out how to solve this, here's our roadmap for today's explainer. We'll kick things off with the income replacement problem, then we'll get term insurance explained. Next, we'll figure out who actually needs it, look at the key advantages and disadvantages, calculate how much you should buy, and finally, settle the age-old debate of term versus traditional insurance. All right, stepping right into part one, the income replacement problem. Look, the absolute golden rule to remember here is that the primary purpose of life insurance is income replacement. It is not an investment. Your family's current lifestyle relies entirely on your income. If that income suddenly vanishes, you need a safety net ready to catch them. The goal is simple, really. It's about maintaining financial independence for your dependents so they can cover the daily bills and hit those future goals even if you aren't around. Moving along to Section 2, Term Insurance Explained. So, what is this thing mechanically? Well, term insurance is the purest form of life insurance you can get. Here's how it works. You pay a premium every single year, and in return for that payment, the insurance company makes a legally binding promise to you. They promise to hand over a massive lump sum of money, what they call the sum assured, to your nominee if you happen to pass away during that specific policy period. It's a remarkably straightforward trade, a small annual fee in exchange for a giant protective net. To see this incredible leverage in action, let's look at a crazy number, 1 crore. If you're a 30-year-old, you can actually secure a 1 crore policy for a 30-year term for somewhere around just $10,000 to $20,000 annually. That is absolute magic. You're literally buying a massive multi-million-dollar safety net for roughly the cost of a daily cup of coffee. Let's quickly run through the key features that make this product such a game changer. First up, high coverage at a low cost. Like we said, that 1 crore policy often costs less than what a lot of people spend on their streaming subscriptions for the year. Second, it gives a lump sum payout, meaning your family can clear out massive debts instantly. Third, you get flexible terms ranging anywhere from 10 to 40 years, so you can cover your working life right up until retirement. Fourth, you can tack on optional riders, things like critical illness or accidental death covers to really customize your protection. And lastly, yep, there are significant tax benefits on both the premiums you pay and the payout your nominee gets, subject to the prevailing rules, of course. Let's jump into Section 3, who actually needs it. So, the crucial point is figuring out if this is actually for you. The rule of thumb goes like this. If anyone at all relies on your income, you need this. Salaried employees with dependent families, essential. Business owners whose income supports multiple family members, absolutely critical. And if you have any kind of liabilities, a home loan, personal loan, business loan, this is what stops your debt from becoming your family's nightmare. It is hands down a must-have for parents of young kids and sole breadwinners. Now, who doesn't need it? Well, if you have zero dependents, or if you're already so wealthy that your assets could easily support your family forever without you working, you could probably skip it. But for the vast majority of us working folks, it's a total necessity. Moving right into Section 4, Key Advantages and Disadvantages. Now, what's really interesting about this slide is that core disadvantage sitting right there on the right, no maturity benefit. In a pure term plan, if you outlive the policy term, you don't get any money back, period. And I know a lot of people find that psychologically tough to swallow. But remember what we said earlier. Insurance is protection. It is not an investment. The advantages absolutely crush that downside. You get super affordable premiums, loan protection, and literally the ultimate peace of mind. Just keep in mind a couple of other things. Premiums do get more expensive the older you get, which is why you lock it in early. And there's a very real risk of claim rejection if you hide your medical history. Honesty is non-negotiable here, guys.
All right, on to Section 5. How much should you buy?
Please drill this golden rule into your mind right now. Your coverage should be 10 to 15 times your annual income. It's really that simple of a starting point. So if you're making 10 lakh a year, you need a policy that's going to offer you 1 crore to 1.5 crore in coverage. Let's break down the exact flow of how you arrive at your own custom number. Step 1, you multiply your income by 10 to 15. Step 2, you add up the total value of any existing loans, because if you're gone, those need to be wiped out immediately. Step 3, factor in those massive future expenses, like sending the kids off to college. And step 4, don't forget to account for future inflation. The whole point here is to build adequate protection tailored for your family's unique situation, not just going online and blindly clicking buy on the cheapest policy you stumble across. Okay, I need to take a serious tone for just a second here, because the stakes are incredibly high. Please, whatever you do, avoid these common mistakes. Buying too little coverage? That just leaves your family vulnerable. Delaying the purchase? That means premiums shoot up as you age, and if you get sick, you might become uninsurable. Hiding medical conditions to score a cheaper premium? Actually, scratch that. It's not just a mistake, it's catastrophic. It leads to devastating claim rejections exactly when your family needs the money the most. Always be 100% honest. And finally, mixing your insurance up with your investments.
Which brings us perfectly to Section 6, term versus traditional insurance.
And this brilliantly illustrates exactly why you have to keep them separate. Term insurance gives you incredibly high coverage for a super low premium because it is pure, unadulterated protection. Traditional plans, on the other hand, try to tempt you with a savings component, but they force you into drastically lower coverage for a much, much higher premium. Listen carefully to this. Wealth creation belongs in mutual funds, stocks, your EPF, or the NPS. Term insurance is solely for protection. Combining a pure term plan with separate, dedicated investments is always going to give you far better financial efficiency. To really anchor this concept, just think about how you handle every other risk in your life. You buy health insurance because medical emergencies pop up. You buy car insurance because fender benders happen. You buy term insurance because your family's future literally depends on it. And the kicker? The best time to buy it isn't when disaster strikes. You literally can't buy it then. The best time is right now, today, while you're young, healthy, and perfectly eligible for those beautifully low premiums. I love this quote from our source material because it summarizes today's entire explainer perfectly. Financial planning is not just about creating wealth. It is also about protecting it. You can build the absolute greatest, most aggressive investment portfolio in the world, but without a protective safety net underneath it, it's just a house of cards. So I want to leave you with this final, provocative thought. Think about it. Is your family's future truly protected if you don't wake up tomorrow? I highly encourage you to sit down tonight, calculate your risks, apply that 10 to 15 times rule we talked about, and take action. Thank you so much for joining me for this explainer. If you found this structured breakdown helpful, I'd invite you to explore more of our content on personal finance and wealth creation. Keep learning, keep protecting your wealth, and I'll see you in the next one.